Welcome, everybody, to the Investors Podcast 2.0 Wealth Mindset, where we dive into the minds of the successful real estate entrepreneur to uncover the tips and tricks that have allowed them to keep moving forward. I am your host, Scott Bauer, and I'm excited that you're here with us. Welcome back, everybody. It is another episode of the Investors Podcast. I'm your host, Scott Bauer. And I'm excited once again today for a couple of different reasons. Number one, excited to be here. Glad that you've tuned in with us. Number two, I got Matthew Sullivan with us with Quantm or Quantm Real Estate. And number three, this is an interesting topic that we're getting ready to talk about because it's a way to look at the equity in your home in a totally different way that I think you're going to find really interesting. So make sure to stick with us. Of course, as always, if you like the show, please like it, please share it, please subscribe to it. We want to make sure you come back each and every week. So you can gather up all this valuable content that we're providing here. So Matthew, how are you, man?
Very well, Scott. Thanks for having me on.
I'm excited to have you here. I really am. Why don't you go ahead and give the listeners a little bit more about your background and kind of what you're focused on now?
Well, I think really for the last 25, 30 years, I've been an entrepreneur, very much focused on finance, real estate, technology platforms. Came to the US 7 years ago and immediately became involved in online finance platforms, crowdfunding, and really came across this very interesting concept about 4 or 5 years ago, which is this ability to unlock the equity in your home without taking on more debt. So just over 2 years ago, we set up Quantm Re, and our mission at Quantm Re is to help homeowners who have equity to be able to unlock that equity without taking on more debt, so that they can get cash with no loans and no more monthly payments and no interest.
So, and I love, because we're going to dive into that to really unlock how somebody's able to do that without taking on additional debt, right? But what I want to find out, before you launched Quantm Re, did you crowdfund to syndicate apartment buildings, to buy commercial assets, to buy other assets like that? Is that the space you were in prior to that?
We were one of the very early crowdfunding platforms. This is about nearly 7 years ago. So I think just as the Jobs Act was, the ink was sort of barely dry, I set up a real estate crowdfunding platform that was designed to raise money into individual projects, and those projects were debt products. So it's very similar. I mean, the sector has grown tremendously over the last few years.
Yes.
But we were one of the companies that started off by enabling accredited investors to buy into fractions of debt that was attached to small commercial real estate projects. And when I say commercial projects, those are residential real estate projects that were being developed by commercial developers.
Okay. All right. So they would invest into a PPM of some sort, right?
Yeah, exactly. So it's absolutely standard. So the properties and the debt products were held within a single purpose LLC. So like pretty much every crowdfunding platform, right, what we were doing was enabling accredited investors to buy fractions of that loan through the LLC.
Now, that is a 506A or B?
506C. 506C. So you've got 506B, so two flavors. 506B, which is for accredited investors, but you can't publicly solicit for those. So yeah, I mean, then you got 506C. So what the Jobs Act did was introduce 506C, which is the ability for you to publicly offer shares or securities without having to have a prior existing relationship, and that was the big sea change in the Jobs Act, which is way back. I mean, how the world has changed since then, I can tell you.
Well, and really too, I'm sure that opened up. So there's a ton of people similar, probably to yourself, that were figuring out how they could launch a product that would be able to gain capital from. Are these only accredited or non-accredited as well?
Well, I think, yeah, I mean, and then, so the Jobs Act had a number of different layers, which are sort of represented by titles. So you have Title 2, 3, and 4. And Title II is the Regulation D, Rule 506C. Title IV, I'm struggling here. So, I'm sure that all your listeners will scream that I've got this the wrong way around. But Title IV is Regulation CF, which is Regulation Crowdfunding, which enables non-accredited investors to buy into investment offerings by companies in the US up to 1.07 million. Then you have Title III, which actually came out probably about 3 years ago, I think, 3.5 years ago, which was Regulation A+. And Regulation A+ is a really interesting mechanism, or it's an exemption that enables you to raise up to $50 million a year from an unlimited number of shareholders, from accredited and non-accredited. It's much more complex. Right. It's almost like a public offering. So it has to be qualified by the SEC, which means that you have to go through the process of getting the SEC to look at your PPM, and you normally have lots of questions going backwards and forwards before they allow you to raise money through a Regulation A+.
Absolutely. And for all you listeners out there, if this is something that is interesting to you, make sure that you connect with a qualified SEC attorney. It's very, very important. Feel free to reach out to me. I have some really good connections I can point you to if this is something that would interest you. But Matthew, why don't you go ahead and dive a little bit deeper into the products that you've been able to develop, or the system that you've allowed homeowners to pull equity out of, their properties and not take on additional debt. I'm interested to hear about this.
Great, and thank you. If you look at what the problem is, so let's throw some numbers around. In the US, there's $17.8 trillion of equity in single-family homes. And that's everything from someone who's got 1 or 2% equity to someone who owns their home free and clear. There are 14.7 million homes where the homeowner has 50% or more equity. And if you think about it, the only way right now that you can unlock the equity in your home is to borrow more money. Now, if you compare that to a commercial transaction, in a commercial transaction, you have junior debt, senior debt, mezzanine finance, equity. You have many layers of fundraising or capital within the capital stack of a commercial transaction. In a residential home, you have debt, and that's it. So There's no way of accessing. So at the moment, unless you want to borrow money secured by your equity, the only way for you to actually get your hands on your hard-earned equity is to borrow money. So a number of years ago, we really felt that was a very poor solution. It's something that really needed to be updated. And over the last 10 years, funnily enough, this concept of shared equity has become far more mainstream. So last year, probably, $750 million, we estimate, was invested into the equity in single-family homes through a financial tool which we refer to as a home equity agreement. But what that does is it enables homeowners to receive a cash lump sum by effectively signing an option agreement, which enables the investor to share in some of the potential increase in value of the home rather than getting paid through interest or other mechanisms that are more traditionally debt-based.
So they're agreeing to put a second on their home, but for the equity and then they're saying that they're going to sell it after that to recoup.
Well, no, yeah. I mean, the most important things are, first of all, as a homeowner, you're not selling any an interest in the title to your home. So what that means is no one else is going to go on title as an owner. But what you're saying is that if I have a home which has a certain value and I've paid off most of my mortgage, the value that's sitting in the equity, that's an asset. That's a real estate asset. And so we have investors that want to get involved in the potential appreciation of that home.
Okay.
So the home equity agreement enables them to invest in the potential appreciation. And when the homeowner sells the home, which can be up to 30 years from the date they signed the agreement, the investor gets paid by getting a share of the amount of money that the home has appreciated over that time. And that's how they get paid. And obviously, they're taking on a bit of risk, because if the house doesn't go up in value very much, they're not going to get paid a great deal of money. But it's very different to a loan, because there are no monthly payments. There's no interest. It's not debt. It doesn't appear on your credit report as additional debt, but it does give you a lump sum up to 20% of the value of your property.
So, okay, let's lay this out there for the listeners in simple, easy math and simple, just, let me see if I can regurgitate what you just said. So somebody has a house that's worth $100,000, let's say. Okay, it's worth $100,000 if they sell it today, and they only owe $50,000 on it, right? They go out and they say, hey, I got this $50,000 worth of equity in the home. I don't want to go to a bank to get a home equity line of credit. Instead, I'm going to go on to Quantm RE, and I'm going to put my house up there, that's 50% worth of equity. And an investor comes in and says, I'll give you $50,000 for the $50,000 worth of equity that you have. They fund the homeowner, and the homeowner gets 50 grand in their pocket. They're going to go on vacation. They're going to buy whatever they're going to do. 20 years comes down the road, and that investor now, or that homeowner decides they're going to sell their house for $200,000, right? So now on the sale, that homeowner owes 50% to the investor. Is that right?
It is. Yes. I think that conceptually that's correct. I think what I want to do is really just sharpen up some of these numbers here.
Okay. Please.
So you got a $100,000 home, and let's ignore the minimums that we have.
Right. Yeah.
But the maximum combined lien to value. So if you add the mortgage plus the investment that we make, it's got to be 70% of the value of the home or less.
Okay.
So if you've got a $50,000 mortgage, that's 50%. So the most that we will invest is $20,000 in your situation. Now, the caveat is that our minimum is actually $35,000. So, your house would need to be worth a little bit more. But
sure,
for the sake of this, this discussion. So, and the way that works is that our investors, and we, it's a process. We don't have to match it. We have this machine already lined up. The investors would invest $20,000, and that would take your combined lien to value up to 70%. And then when you sell the home a little bit later on, the house has gone up from $100,000 to $200,000. So obviously that's a fairly decent increase. Now, the investor says, well, when you sell your home, we'd like to get back our original investment. So the homeowner will repay that initial $20,000 investment. Plus, the homeowner will share in a percentage of that increase in value. And that share is entirely dependent on how much they got in the first place. So because they got $20,000, that's 20% of the value of the home.
Correct.
So the sharing ratio would be a multiple of that. And it depends on who the investor is and where the program is and what the house is. But typically, the sharing ratio will be between 2.5 and 4 times that figure. So the homeowner will end up paying between 50 and say 75% of that increase in value. And that's how the investors get paid. But remember, it's, for a house to double in value is pretty good going. What tends to happen is by the time the homeowner sells the home probably has only gone up, say 10 or maybe a little bit more than that, 15%. So the actual amount that the investor gets is not going to be that whopping return that you're looking at. It's going to be much more in line with, with traditional financing.
So then, and that makes a lot of sense. But then on the investor side, then it's a safe. So why would I want to invest in a deal like this, right? And so a couple of reasons.
For a start, you're getting access to properties that are not for sale. So first of all, you're getting an equity return on a residential home that's owner occupied. So you get to share in the equity upside, and you get a magnified share of the upside compared to the homeowner, because the contract says, even though I've only got 20% of the equity, I'm actually going to get maybe 50 or possibly a little bit more of the increase in value. So the investor gets some upside based on the equity return. The home is looked after by the homeowner. The homeowner pays the mortgage, the taxes, looks after the property. So there's no cost, or very, very little cost associated with maintaining that asset. And if you compare that to something like a rental property, where there's all of the overhead attached to maintaining the property, collecting the rent, if the rent goes behind, then you have all of the costs associated with managing that. So it's a lot less expensive to maintain the asset. And also, the investor has some downside protection. So if the house goes down in value, then the homeowner will share in a certain amount of that downside as well. So from an investor's perspective, they get access to equity appreciation in a asset class that's very well understood. A large number of companies are able to price that, but most importantly, they get to share in the equity appreciation in houses that are not for sale. So that opens up an entirely new, enormous asset class.
So, I mean, I've never heard of this before, something like this. What challenges have you found in the time you've been doing it with homeowners agreeing to sell some of their future upside, right? Because somebody might say, that's great, I get this cash today, but what happens if my house goes up in value dramatically? I want to also, let me rephrase that. Have you had a homeowner that their value has gone up dramatically, and then when they do sell, they're upset because they've had to give away so much of the upside to that investor? Have you had that?
Well, there are a number of not so much protections, but there are a number of layers built into some of these agreements. Now, some of the agreements that we work with have a cap. So in other words, the investor says, okay, if your house does rocket up in value, we will cap the amount of return that we can make on an annual basis. So that makes it much fairer for the investor. But you're absolutely correct. And the biggest challenge that we have is education. In other words, many of the people that we speak to say, this is fascinating, but I've never actually heard of this before. So we do have that challenge of explaining to people how it works. But also, I think at the beginning of the year, one of the other challenges that we had were people who were very confident that their house would be going up in value and were reticent about tapping into some of the equity, even though there is no monthly payments or added debt. Now, because of the changing economic circumstances, I think people are far more willing to look at this as an option because they're less confident that house prices will continue to storm forward at the same rate that they were at the beginning of the year.
Well, that's absolutely true. Of course, they're not going to do that. I mean, as a smart investor, if we look over the last 100 years, we know that no matter what happens in the economic environment today, if we wait it out long enough, values are going to go up because inflation goes up, because, this is the nature of what real estate does, right? It always goes up in value. What about for the investor that's investing in it, who doesn't? It sounds like that investor needs to be a very passive investor who doesn't need the returns on a monthly or even yearly basis. Somebody who's able to wait up to 30 years in order to get a return back. Is that right?
And that's the source of capital. And again, one of the challenges really is educating the capital sources. Yeah. And again, what you're saying is absolutely correct, because the capital sources that invest in these programs have a longer term investment horizon. Yeah. So what they're looking for is a stable investment backed by interests in physical real estate that enables them to provide a return that doesn't have a cash pay. And if you look at the hedge funds, the institutions and the pension funds, the other types of endowment funds that are invested, their investment horizon is much longer. Yeah. So they don't need to have that immediate sort of cash pay or that immediate return. But having said that, the average duration of a contract is between 5 and 7 years, because most people don't stay in their homes for 30 years.
Right.
They do tend to move far earlier than that.
That's absolutely true. And I could see, that's the average, I think 5 to 7 years on somebody moving homes. So, that's a typical, 5 years is a typical investment horizon. So it's not out of the ballpark by any means.
I think we're beginning to see that as well. We're beginning to see that these contracts or these agreements do follow the same pathway that most other agreements. So we're not seeing that when people invest in these, there are a particular demographic that are going to stay in their homes forever. But having said that, what we are seeing generally across residential real estate in the US is that people are staying in their homes for longer. And I think we'll see some real shifts in that because of COVID, where more people are going to be holding on to their homes there. We're seeing more demand for improvements, for expansion, building auxiliary or accessory dwelling units.
Mm-hmm.
So it's very interesting to see how the dynamics of housing is changing because of the COVID pandemic.
Well, not only that, but also working at home, right? People are now adding on to their homes for an extra office so they can work at home, things just like that. Now, here's another question. Are you pooling groups of homes together to sell them as a security to these larger funds? So let's say you have 15 or 20 or whatever residential houses that are interested in a program like this. You pool them together, then you sell them as a major security to to a life insurance company or an endowment fund or somebody that has a lot of capital stacked up, ready to deploy, that they have a longer time horizon. Have you thought about that yet?
Yes, and that's where it's going to go. Now, the reason that's going to happen is because of the size of the asset class. So this is not by any means a niche market. There are trillions of dollars. So it's similar, if not larger, in potential size to residential mortgages. So what we're seeing at the moment is investors are buying and holding these assets for their own purposes. What we're building, though, is a secondary market capability that enables us to originate transactions on behalf of third-party capital sources, and for those home equity agreements subsequently to be fractionalized and sold through a secondary market platform that we currently have under construction. So going forwards, I think most of us in the industry believe that what's going to happen is that there will be demand from capital sources to buy these in tapes in the same way that mortgage-backed securities were sold. But obviously, it's a very different asset, and it absolutely will not have anything to do with any potential future crash. So in case anyone's saying this is just a rerun of 2007, it's absolutely not, because it's a completely different asset class. We're working with homes that already have a ton of equity. And so we're not asking people to borrow more money. And I think that's what caused the one of the critical components of the crash in 2007. I just want to make that clear. So,
well, and you're also not asking people to max out their equity, right? So you're saying that there needs to be at least 30%.
30%, yeah. So they have to have at least 30% left over, because they have to believe rightly that they are still the owner of the home. So we don't want to go any more than that for that and other reasons.
Well, and it also would protect you as the investor as well, because that they still have a lot of skin in the game. 30% is quite a big
correct.
If we look back at 2008 in some areas of the country, yes, it fell 40-50%, but for the most part, you're looking a major correction is 20%. So even if there was a correction of 20%, they would still have equity, right?
They would. And also, from our investors' perspective, remember, those homes have to be sold in order for our investors to crystallize a loss. And what tends to happen with these homes where there is all of that equity, the owners don't sell, because, as an owner, if you have the ability to withdraw cash through equity-based financing such as ours, that gives you the capital to ride out these storms without monthly payments. And that means that you're far less likely to sell in a downturn.
Right.
But if you're mortgaged up to the ears, then you are the sort of person that probably has to sell because you can't meet the payments and you don't have the equity. So that's, we are insulated because of that particular type of homeowner that we work with.
So, okay. What would you say? Well, there's also from an investor standpoint, there's no tax incentive, right? So you get no depreciation. You get no, there's strictly a cash investment. You're not getting any return until the sale of the asset. And I'm just trying to understand and make sure that I can comprehend all of it. You're not getting you're not getting any cash. There's not monthly payments, but you're also not getting any depreciation. You're getting no, asset write-off or anything like that because you're strictly investing your cash for a return at the sale of the asset. Is that right?
Well, you're buying into an option agreement. So it is a capital gains transaction. So remember, you've got the cost of the option, and there are tax incentives for investors. So in other words, the way that these options have been structured, there are tax benefits. And from a homeowner's perspective, our understanding, and again, the caveat is this is not tax advice, but the capital that you receive as a homeowner is tax deferred because it's an option agreement, which means it settles at some point in the future. And so because of that, the capital that you receive under that option agreement as a homeowner has no immediate capital gains or income tax liability. So that means that you do settle up ultimately when you sell the home. So if there are any tax implications, those are all settled up at that point. It just means, though, it's great from a homeowner's perspective because they've got $100 that they can do with what they wish.
So what about from a I guess a tax perspective, or changes within the tax code? I mean, what issues do you find that you might run into moving the next 3 to 5 years? Are there any?
Well, again, we don't see anything that's on the immediate horizon and or long-term horizon because what we're doing really is something that is tried and tested. It's not. It's an option agreement that has been operating now for over 10 years. So we don't foresee at any stage that there's going to be some type of change in legislation that we are anticipating. And obviously that doesn't rule out something that no one anticipated. But what we're doing is something that is, it is relatively straightforward from a tax perspective. It's well understood. It's not, there is no gray area. And so, we don't foresee any legal, regulatory, or tax challenges.
This is an extremely unique perspective and way to look at things. And I think you're onto something. This is a niche out of something that's been tried and true, right? It's been around for a long time. This area, the secondary market that you said that you're developing right now, I think could turn into something that we might see a lot of in the future, right? Because, you're modifying how people can access the equity in their homes, and then therefore building and bridging out a whole new market out of it, right? I mean, that's
and really it is, but the demand is there. So in other words, homeowners are motivated. So the product is great for homeowners who cannot borrow money or who don't want to borrow money. So it's not a reverse mortgage. It does not eat into their existing equity. It does not have monthly payments. So with the current economic situation, it is ideally suited because it provides access to trapped equity without all of the issues. But this is not a magical formula. This is really just equity-based financing. And all we're doing is we're using a model that has been working with commercial real estate since the beginning of time. And we're just saying, hang on a minute, as a residential homeowner, no one's interested in the equity for some reason, but the way that we've structured these agreements, now investors are really interested. So what we're doing simply is just creating the financial mechanisms that matches the investor with the asset so that everybody wins. And I think the timing of that and the scale of the market means that we will see real growth in this type of equity-based financing over the next few years.
That's awesome, man. Matthew, I appreciate you being here today, sharing this with us, because this is something.
Thank you. No. Pleasure's mine, believe me.
Just for sake of time here, are you ready for a lightning round?
Yeah, absolutely. Yes.
All right, let's get into it. First question is, how important do you find that mindset is on, the success of your business?
Well, they say that mindset isn't anything; it's everything. So, I mean, if you don't have the right mindset, you might as well just, pack up and go home and don't even bother getting out of bed. So it's everything.
Absolutely.
Next question. It is. It's everything. It really is.
Especially, you're thinking outside the box when it comes to what you've been able to develop here. And so that has a whole nother side of the mindset that you have to explore. Right. And so
it's much deeper than mindset, saying you have a positive mindset. You have to have absolute belief in what you're doing and the courage of your convictions. And that you can't fool yourself. So in other words, you can't try and convince yourself that this is the right thing. So, if you do have belief in something, then you just have to see it through. And mindset is positivity, but it's also, pure dogged determination.
Mhm.
That's the piece that makes it work. All these discussions about, 5% inspiration and 95% perspiration. That's absolutely true. So, mindset is about, being there, turning up, and then just badgering away day after day until it works.
Absolutely.
And that's so important.
Divine devotion. That's definitely what it is. Thank you for sharing that. What are you reading right now?
There's a great book. I met a guy called Chris Voss. And Chris Voss is an ex-FBI negotiator, fantastic guy. He has this sort of, stare that chills you to the bone. But he's got this great book called Never Split the Difference, which is just fascinating because it's all these sort of nuggets of, there you go. Perfect. Yes. Yeah. He's reading that. Well, I'm reading that. So he's probably reading it too. Yeah. But
everybody that's on this show, if you're listening to it now, if you do not have a copy of this book, go out there and get it. It will change your life. It'll change how you live and how you interact with people. I promise you it is. So thank you for sharing that. What are you trying to learn right
now? I'm trying to learn to play the drums. I'm not sure if I should admit this in some sort of public venue. So I have a 5-year-old son. I have lots of young kids, but one of them is a 5-year-old boy. So I thought, wow, okay, this is a great excuse to buy one of those electronic drum kits. And not buy one of the kiddie versions, but buy one of the sort of super grown-up adult versions. And of course, I have to try and explain how to play the drums, which means that poor Ashton doesn't get a look in. But no, it's one of those things I've always wanted to do. I've discovered, fun enough, that I'm actually really rather bad at it. And so I can't get any worse. So improvement is the only way forward at this point. So that's good for me.
That's phenomenal. That is phenomenal. I play a little bit of guitar here and there, and I understand the challenges that come with learning an instrument. That's for sure.
But the rewards, when you get that sort of, riff or whatever, is, causes cold winds of excitement to brush across your temples.
Very, very self-fulfilling. That's for sure. What would you say that you have a superpower of any sort?
Yeah, this is one of these, I mean, one is always inclined to sort of, be rather embarrassed. But I think over time you realize that there's probably a very small number of things that one is good at. And the trick is to try and figure out what that is. And I hate saying I'm good at something because one always wants others to be the judge of that. But I think over time, my successes have come from integrating things. So I'm not a great inventor. There are many things that I'm not good at, as anything like as good as a specialist. But what I seem to have a knack for is pulling lots of different things together, whether it be different ideas or different technologies, and somehow making them all work. So I suppose, I've got a good helicopter view. I'm a good integrator of things. And that's what sort of kept me busy, and that's what's paid the mortgage over the last few years.
Awesome. Well, I appreciate you sharing that. It's very important to be an integrator. That's actually one of the yin and yang, right? You have to be an integrator, somebody to integrate those massive ideas for people. And you've obviously done that. So thank you for sharing that. How do you like to give back?
Well, again, this is when I saw your questions, I thought, well, I've got two options here. I can either tell the truth or I can make something up. So I thought I'd make something. No. So the truth is, I've got 4 young children, age ranges 9 years to 10 months. And, they're all consuming. So to try and give them the best start in life, I don't have bandwidth, brain capacity to do anything outside of that. I'm sure as they get older and leave the nest, then my focus will be on how do I do I think. But my entire focus is on, and this is like the second time around for me. But how do I not make the mistakes that I made in the past? How am I going to be a good father based on all of my learnings and all the mistakes I made? And how am I not going to screw it up this time round? And so that I think is my entire focus. I would love to give back, but that's, I'm trying to, I think that's probably, if I can not, if they can leave the nest rounded humans with some idea of what is right, then I've, maybe done a half decent job.
That's a phenomenal way to give back, because by doing that, you're then giving back to society. You're then giving back to our population of humans. You're therefore giving back by taking care of, of what's most important, which is your family. So thank you for sharing that.
I did have some other really cool things that I was going to lie about as well, but I think
appreciate you giving us the truth. That we all appreciate that. Where can the listeners find you? If they want to get in touch with you, learn more about Quantm RE, learn about how they can access the equity in their home or somebody that they know, where can they find you at?
Well, it's all on the website, which is Quantm RE, Quantm RE. So there's all sorts of contact details there. There's ebooks, there's videos, podcasts, and there's a calculator there where you can find out how much equity you could unlock. We try and be as responsive as possible.
Right.
So please take a look, kick the tires, send us an email, give us a call. We'd love to hear from you.
Yeah, and thank you for sharing that. We'll make sure to add that into the show notes. As always, all you loyal listeners that have stuck with us up to this point, I know you're interested. So make sure to check back at the show notes if you're driving, of course. Pull over. Do not do it while you're driving, and check them out. There might be some money that you could tap into there. Matthew, I really appreciate you being here, man. This has been very unique. I've enjoyed our conversation.
Me too. Thank you.
Thank you for being here. We'll talk to you real soon.
Absolutely. My pleasure.
Okay. See ya.